Get a nice new fresh recording. Okay. So after we did the session a couple of weeks ago, that was kind of an advanced inventory session, right? We looked at how to take account today and then use the data that we did have available to back into what inventory would have been, let's say back to December 31st, which happens all the time. You get a new client, you're cleaning up their books, and you're like, did you take inventory December? And they're like, no, we were supposed to do that, and it's like, okay, so take account as soon as you can, and we'll back into the number. It's, as you saw, and I created a template for you, which I can't remember if I put that template up when I posted the recording. I think I did. But if I didn't, let me know and I will. But this way you back out the sales from January 1st through today, and you back out the purchases from January 1st through today, and that gets you back to what the inventory would have been. Well, a couple of people remarked to me that, it was kind of advanced stuff. Jesse, actually, who had joined our call that time, said that he had a new client who, where he was dealing with inventory and he needed the basics. And then, Greg had mentioned, I think, that he could use a refresher on it, right? Because inventory is one of those things that a lot of people kind of choose. Either I'm going to deal with companies that have inventory, or I'm not, right? And a lot of times we want to avoid it because it's a lot of headaches, it's a lot of moving parts. I had gotten away from inventory for a while, and then I was sort of thrown back into it because I was thrown into the e-commerce world by a guy who desperately wanted me to do his accounting. And I kept saying, I'm not the guy. I don't really do e-commerce. It's not my thing. And then I started reaching out to people who, who I knew of, who were known for e-commerce, and they were all up to their eyeballs in it. And one person in particular I reached out to who said, I got her name from, somebody that we knew mutually. I didn't actually know her. And when I got her on the phone, she said, I love your work. I've followed you for years, blah, blah, blah. I'd love to work with you, but I'm up to my eyeballs, because I was offering that we could do like a hybrid. She could deal with the inventory and e-commerce part, and I can handle the rest, and we would share the client. And she couldn't even do that. She was so busy. So, of course, the message I was getting was people that deal with companies that have inventory are very busy, which means economics 101, supply and demand, right? There's obviously very high demand for people who know how to do this stuff, which means there's short supply, which means I can charge more, right? That's the bottom line, right? So we can make more money because we do something that others aren't able to do and frankly aren't willing to do because they just don't want to deal with it because it's headaches. So of course, when you do take on inventory-based companies, you definitely should be charging more than what you would charge for a simple service-based business because it's more complex. So the value of what you're doing is obviously much higher, right? So that's important. Remember that. And, if you're still billing by the hour, charge a higher hourly rate, right? If you're charging flat fees like me, I have kind of e-commerce rates where everything's a little higher than what I would charge for a service-based business, in terms of a monthly fee. And I almost always will charge some kind of a setup fee in the beginning because most of the time when I take on an inventory-based client, there's work to be done to clean things up. For example, usually the inventory's not been counted, and even if it has, it's usually off, right? Most of the time, if I get in on a Zoom with a client and I run their balance sheet and I say, does this look like about how much you have in inventory in the warehouse? 9.9 times out of 10, they say, nope, it's either way too much or way too little, but definitely not right. So then we go into a valuation summary and we kind of go, and I tell them, I export that into Google Sheets, share it with them and say, go take account, and then we can make the adjustment. That's the only way you're going to clean up inventory is take account and adjust it. No other way. Right. And then the only other issue, like we discussed last time, is how to, how to back into the number, which is exactly what we covered in the last video. So Robbins in the chat says, do we ask questions in chat or Q&A? I have no audio. So yeah, just go ahead and use the chat. I'll try and keep an eye on it to cover your questions there. And so, so then today I said, let's do the basics. Let's start from the ground up and kind of talk about an inventory deep dive. And, the way I think of inventory is a lot the way I think of buying stocks, right? What do we want to do when we buy stocks? We want to buy at one price. We want to sell it at a higher price. And that's essentially how inventory works, right? We buy the inventory wholesale. We sell it retail. Hopefully retail is enough more than what we paid wholesale for it so that inside of that profit, we can cover, the profit being the difference, of course, between what we charged and the cost of goods sold, which is what we paid for it. Hopefully there's enough in there also to cover our overhead and everything else that we have to pay for, right? And in most cases with inventory businesses, the gross profit margin is going to be fairly thin, right? And depending on the kind of product, we're often counting on volume, right? So we sell a lot, high volume, and that's the basic model is if it's a lower price item, then we're usually counting on high volume, right? The opposite end of that spectrum is I have some very unique specialty type of item where I'm selling fewer of them, but I'm selling it for a lot more, and there's usually a much bigger gross profit in that, right? So, and there's lots of examples you can think of like that. Think of like, a beverage business, right? Coca-Cola probably has a very narrow profit margin compared with, I don't know, what's a high-end kind of beverage that somebody can buy. I was watching a TV show recently that was based on just things that are very expensive, and there's a kind of water you can buy that's bottled at some spring that's hard to get to, whatever it is. And of course, the packaging itself there's like diamonds on the cap. So a bottle of this water is like, I don't know, thousands of dollars or something. It's something crazy. It's something people buy just for a status symbol to say, look, I'm so rich and famous, I can buy this water, right? It's dumb, but it is what it is. There's stuff out there for people like that who have nothing better to do with their money. So anyway, that's kind of the two ends of the spectrum in terms of your inventory model. Bottom line, accounting wise, not much changes from one product to another. In the end, it's kind of simple. I buy it at one price. I'm hoping to sell it at a higher price, and we need to track that, right? So of course I'm oversimplifying because it's easier to understand it when I do it that way. So let me share my screen and we'll take a look at a couple of things here. All right, and then we'll minimize that so it's not in the recording. All right, let me get my participants window up here and I'll bring up the chat so I can see if anybody's trying to chat me. Perfect. Okay, so let's just pull up a blank spreadsheet. All right, Greg, what are we selling today? What do we want to sell?
We want to sell cell phones.
Cell phones?
Yeah.
Okay, sounds good. We're going to sell cell phones. All right, so let's start with purchases, right? We're going to buy cell phones from Samsung, right? So my vendor, Samsung. Okay. I'm going to buy, I don't know, we'll call it Model X. I used to have Samsungs, now I have a Google Pixel, so I don't even know what the Samsung models are anymore. Model X, okay. Quantity purchased, unit price, total cost. Okay, so let's say I'm buying, let's make it 100 cell phones from Samsung for my Verizon store or whatever it is. Okay, and I know that these phones these days, especially the really smart phones, are, what are they, like $1,000 now? Something like that for a phone?
Yep.
All right, so we're buying them. Let's just say let's call it a third of that. Let's say it's 300 each. Probably even less than that. I'm sure they're making a ridiculous profit on these. All right, and then let's just make this look a little prettier. And of course, this is simple math, right? I take 100 units at $300 a piece. So I'm going to place this order with Samsung, and they're going to send me a bill for $30,000. I'm going to pay them, and I'm going to have 100 of these phones, right? Now, let's say I realize that, demand is going to increase for these. So I realize after I place this order, and then that I need to place another order, right? So let's say this was placed on, and while we're at it, since I was talking about it this morning, I'll show you a cool trick. If I go to data validation under the date for criteria, I can choose date, and it just needs to be that it's a valid date. And now I can use your little calendar thing, which is so cool. I love that. Okay, so let's say that was on May 1st, and then copy that down so it picks up that formatting. And so let's say now it's May 6th, and I'm like, oh my God, I need like 100 more of these, right? But because the demand is going up, Samsung says, yeah, we can't give them to you for 300. This time we need to give it to you at 325 a piece, right? So they're going to jack it up on me, right? Taking advantage of the increased demand. Uber does surge pricing when there's more people trying to request rides. Everybody has their version of that. It's a basic supply and demand model. When the demand goes up, we increase the price so that we can match the supply with the demand. That's why we want to do inventory clients, because we can charge more, we can make more money on it. So we take fewer clients on, charge more money, so we make more money, presumably doing less work if we price it right. And there's definitely an art to pricing things in such a way that we get excited to do the work for what we're getting paid to do it, because we can get good and efficient with our systems about this, so we can get it done in very little time, relatively speaking. And so it feels like we're making really good money doing something that's hard to do, for clients who really appreciate it and feel like they're getting tremendous value for what they're paying, right? And so what I'm trying to create here is a model that has two different prices for the same product, right? Now, if I was using QuickBooks Desktop, what QuickBooks Desktop would do, it was that cost-wise, cost per unit-wise, is it would say, okay, so I have 200 in total units on hand, right? And we would take, let's just sum that up for a minute, right? So we have a total cost of 625, right? Divided by the total units. I did that wrong. Backing up. Total cost of 625. No, I'm sorry. The total cost is this. Duh. Okay, so the unit price is going to be based on the total cost divided by the total quantity. So our average cost per unit is $312.50, right? And so if we were doing this in QuickBooks Desktop, when we sell a unit, this is the number it's going to use as the cost of goods sold per unit. So for each one that we sell, this is the amount that's going to come out of our inventory asset and go into our cost of goods sold account on the P&L. Okay, so looking at that scenario, let's just come over here to the right. You know, these are the purchases. Over here, let's look at sales, right? So we're going to say, I'm just going to copy these dates over so I get that same validation going. So the date, customer, right, same thing, model, quantity, unit price, this is what we're selling it for, total cost. Okay, so let's say we're selling on May 10th, right? This way it's after the point where we've had both of these purchases at these tiers. Okay, I don't care about the customer. This is going to be Model X. Okay, now let's say I sell two of these, and earlier we said they're about 1,000 a piece, right? Right, so I've got two of these sold at 1,000 a piece. Okay, so now what does that look like on the balance sheet and the P&L, right? So we're going to do sales, debit and credit. We're going to do inventory asset, debit and credit. And I'll come down here just so we don't go too far out to the right. And we need COGS, debit and credit. And then we'll do cash, because we'll assume we're selling these in the store and we're getting cash. We all know, of course, in reality, you get a payment plan, you pay it off monthly, whatever. That's a whole different story for another day when we want to do a deep dive on retail accounting. So I'm going to keep the cash part of it simple. We're going to assume that everybody's just paying for the whole phone all at once. Okay, so now we've got this. So first we've got these purchases, right? So in purchase number one, we're buying 100 of these at 300 a piece. We have $30,000 in cost, which means we'll assume we're also paying cash for everything right up front. Okay, so sales, inventory, cash, and COGS. Let's widen up these columns so we can see. Okay, so on transaction number one, what am I doing? I am paying cash, right? And it's going to go into the inventory asset account. So I'm numbering these so we can kind of trace these through. And let me just kind of highlight them so they're easy to recognize, right? Okay, so in transaction 1, I debit inventory for $30,000. Okay. And I'm going to credit cash, right? Because we're paying cash for this. So this is also transaction 1. That goes there, not there. Okay, so there's my debits and credits. That's pretty straightforward. Then I have purchase number 2. All right, so on purchase number 2, I have another $32,500. Same way. Okay, let's get these formatted like numbers. Okay, pretty easy, clear as mud. Now we sell some for $2,000, right? So the question is going to be, what's the cost of goods sold? Like I said, if this was QuickBooks Desktop, we would be using the average cost. It would be $312.50 each, right? Let's change this to make the language really clear. Total selling price, right? So the cost of goods sold on that would normally be $312.50 times the number of units, right? So it would be $625. But that's not how QuickBooks Online calculates inventory, right? That's a major difference in terms of how QuickBooks Online calculates inventory. To figure out the cost of goods sold, the way QBO is going to calculate it, it's a little more complicated. And here's why. It's initially just going to be $300 because QuickBooks Online uses what's called first in, first out, right? So we're going to sell through the first 100 at $300 per unit. That's going to be our cost of goods sold. Once we sell through all 100 of these, then we start costing them out at $325 per unit. So QuickBooks, of course, does this for us in the background. And if you run reports, QuickBooks will average cost it just for the sake of the report. But if you, and I've done videos in this in the past, if you actually go, if you post a sales receipt or an invoice for the sale of inventory, and you can test this out where you set up a purchase for 100 at 300, another one for 100 at 325, sell 105 of these, and you'll see very clearly how it gets cost of goods sold. It does the first 100 at 300 a unit, and it does the last 5 at 325 a unit. If you multiply that out and add it up, you'll see it comes out exactly. It will not, and if you try on the other hand to calculate it based on the average of $312.50 per unit, not going to work. Right? You're not going to get the right cost of goods sold number when you're doing it on a FIFO basis. So in this case, because we're only selling 2, we're only selling at this unit price, or unit cost, I should say. All right, let's change that nomenclature so it's super clear.
Seth, why do you say that you're not going to arrive at the right number as long as you've elected the FIFO inventory calculation?
I'm saying if you try to, outside of QuickBooks, calculate it based on the average cost, you're going to get a different cost of goods sold number when you've sold through the first threshold.
Gotcha.
Yeah. So in this case, again, we're only selling 2, so we're going to be left with 98 of these. We're still at 300 a unit, right? So the cost of goods sold here is going to be 600. Okay, so when we sell the 2 units at 2,000, cost of goods sold 600. So selling price 2,000. That's what we're going to get in cash, right? We're going to debit cash. This is transaction number 3. Okay, and this is going to be 2000. Okay, now we're going to credit inventory, and we're going to debit cost of goods sold for the rest of the sale, right? So inventory is going to be reduced by $600, right? So we credit inventory, and we debit cost of goods sold 600. Okay, so we credited income 200. We credited the inventory asset 600. We debit cost of goods sold 600, right? Let's lay this out in a little trial balance because I want you to see, of course, how this all actually balances out. And sales, by the way, is also going to be 2,000 in transaction number 3. Let's just put that there, just so it lines up. Okay, so let's do a quick little trial balance on this, on the sale, because this really helps. It really helped me when I laid it out this way years ago when I was really trying to understand what's going on here. So in transaction number 3, debit credit. Okay, so we're going to debit cash for the wholesale amount 2,000, and we're going to credit sales, the income. I can't type. For 2,000. And then we're going to credit inventory for 600 and cost of goods sold for 600. So you can see how this balances, right? My debits and credits are 2,600 in total. It balances. And of course, my gross profit on this is going to be the sales amount. Let's do that out here. Minus the cost of goods sold, right? So I made $1,400 on this sale. Okay, now let's do a transaction where we wind up crossing the threshold, right? So that you can, again, see the rest of that picture. So we have 98 left at this tier, right? And we still have all 100 at the 325. Again, we're going first in, first out. So let's say now I sell 110 units, okay? So on this date, on the 13th today, Model X, we're selling 110. And let's just say we didn't increase our prices, we just ate the difference based on the increase. Okay. So now our total sales is 110,000, right? It's Christmas time, everybody came in and bought new phones. Okay, so now the big question mark is, what's our cost of goods sold here, right? So let's just kind of fill that in like that for a minute. Now we have to go calculate it. So let's go, I'm going to insert some rows so I can calculate it, okay? Because now I have, remember, 98 left at 300, okay? Then I have the difference of 110 minus the 98, so 12 at 325. Oops, I clicked on the wrong thing. That times that. Okay, equals sum. That's my true total cost of goods sold number. Okay, and I'm going to go into QuickBooks next, and we're going to post this stuff so you can see it, so you don't have to take my word for it. So now we have cost of goods sold of 33,300. So here's what that looks like in transaction number 4. Let's start with the sales part. Right, total sales was 110,000. Credit. Okay, transaction 4. We're going to credit inventory for 33,300. Okay, we're going to debit cost of goods sold for the same 33,300. Okay, and we're going to credit cash for the same 110,000. Right, same idea. The debits and credits are always going to balance. It's pretty easily done because your cash and your sales is going to be the same. Now, keep in mind, cash might actually be accounts receivable in some cases, especially, and if we're putting them on a payment plan, like I know I pay like a monthly lease for my phone, then in reality, this would be broken up between the amount that I give them today, and then the difference would go to accounts receivable, right? And there's often going to be some warranty revenues. Retail accounting, like I said, can get infinitely more complex on something like this. So we're keeping it simple for today so we can focus on the flow of inventory costs. Okay, so that's how it rolls down. So we've got, again, transaction 4, credit of 110,000. This is a debit to cash of 110,000. Those two offset. Inventory we're reducing by 33,003 with a credit, and that's moving over to cost of goods sold for 33,300 as a debit, right? So our entry balances perfectly. Any questions so far before I enter this in QBO to prove it? All right, I'll take that as a no. So it's clear as mud?
Clear as mud.
All right. Let's go to QBO test drive. I'm not a robot. Then we're going to recreate the exact scenario here, right? This is Nerd's inventory deep dive, so I know what this is later. And I'll clean this up and make the template available. I'll post it with the recording. So I know we already have some stuff in here, but we're just going to ignore all that. And I'm going to go into my products and services list, and we're going to create a product that's inventory based called cell phones. So inventory, Greg's Samsung cell phones. All right, and for the SKU, we'll put GSCP. Okay. New category, Greg's stuff. I just like to play. I never use this. Never put an initial quantity on hand. That creates this opening balance entry, and I hate it. I'd rather bring it in my way. As of date, I always backdate the crap out of this because otherwise you end up getting stuck, unable to enter a transaction because you're trying to enter a transaction, you know, prior to this date. So I always go like way back in time. So here we are, January of 2019, just to make sure that doesn't get in my way. Okay, the income account, let's add a new account called cell phone sales. I just want this to be crystal clear when we look at the P&L and balance sheet later. So we've got cell phone sales, save and close. Let's add a new cost of goods sold type. Cell phone COGS. And save and close. Oh, so 0. Leave me alone. See what's cool about this now, because I categorized it. I can say, just show me Greg's stuff. I only care about Greg's stuff.
Me too.
Exactly. Okay, so it's taxable. I'm going to make it not taxable because, again, that complicates things. And I don't want to complicate things right now. I just want to focus on the inventory flow, but obviously this would normally be taxable. Okay, so now let's go enter a bill, right? Our first purchase was going to be on May 1st for 100 units at 300. Okay, so new bill. Actually, not a bill, because I kind of in the trial balance I did it as cash, right? So we're just going to do a new expense. Okay, and of course I'm going to use my item details, right? We have Greg Samsung cell phones. We have 100 of them at 300 each. $30,000, right? Coming out of my checking. Samsung is the vendor. And save. And this is going to be May 1st. Okay, before I save this, let's go to the videotape. Look at my balance sheet. And we're going to look at the P&L. Because when I'm doing this, especially when I'm trying to get my head wrapped around it and make sure I really understand it, what I like to do is pull these up and predict what I'm going to see and where before I save the transaction, right? So here, we're adding $30,000 in inventory costs to the inventory asset account, and it's coming out of the bank account, right? When you're looking at a screen like this, you can really, in your head, it's helped me a lot to train myself to think in terms of what's being debited, what's being credited, right? When I record an expense transaction and I'm using a bank account, for that matter, whatever account I put in here, whether it's a bank or a credit card, that's the account that's being credited, which means that any account I use here, or whatever account is linked to the product or service that I use here, is what's being debited, right? Which makes perfect sense, because when I use an inventory part here, then the account that gets debited in an expense transaction is that asset account that's associated with this product or service, which of course is the inventory account, right? So there's $30,000 we're going to be adding to inventory. Let's look at the balance sheet. Right now I have inventory of $596.25, so this is going to increase to $30,596.25. The difference is going to come out of cash. We're going to go very negative because we don't have enough money, but that's okay. That's the great thing about playing with fake money. Save and close. Over to the balance sheet. Run it. Sure enough, my checking went negative, but my inventory looks exactly like I expected, right? All right, let's record the second purchase. We'll do this one a lot faster because now that you've seen it, in fact, what I'm going to do is I'm going to go to this expense and I'm going to copy it. Okay, this one happened on May 6th. And when it comes to inventory transactions, when you're recording the purchase and sales, the dates are really important because this date is going to drive at what point in the timeline it shows up in your inventory account, which is going to very much impact that calculation of the first in, first out basis cost of goods sold when the time comes. So this date is very, very important. All right, so we got this. This time, though, they raised the price to $325. We're buying another 100 units. So now we're going to add another $32.5 to inventory, and we're going to be taking that out of a checking account that's already pretty negative. So save and close. Back up to the balance sheet, run the report. Sure enough, I'm very negative in the checking account, but I've got all my inventory there at $63,096.25. And this said $62,500. What is wrong? Oh, because I had that other $596.25. Duh. Okay. Okay, and of course, nothing has happened whatsoever on the P&L so far, right? All the action's been on the balance sheet. Money came out of a bank account and money went into inventory. That's literally all we've done is transfer money from here on the balance sheet down to here on the balance sheet. We've converted one asset into another. That's all. We've converted cash to inventory. And again, it's going to really help you to understand it at that level. Next, let's sell some stuff, right? So these were transactions 3 and 4. I didn't mark them here. 3 and 4. Okay. So now we're going to sell 2 units. Let's go back here. Yeah, let's do it from here. So we'll just do a quick sales receipt. Okay. We'll sell to some customer. Okay, what was my sale date? Was going to be May 10th. Product or service, Greg's cell phones. I got 2 of them at $1,000 a piece. Okay, so what's going to happen now is I'm recording the sales receipt. So now I'm recording the sale. So what's going to happen is we're going to reduce inventory by $600, right? And then we're going to increase our income, right? I created a separate income account for this. So we're going to see cell phone income show up here for $2,000, right? And then back over here, we're going to see this negative $61,299 decrease by $2,000 because it's going to get less negative, right? We're going to add $2,000 to this number, right? So this is going to increase by $2,000. This is going to decrease by $600. Sales is going to increase by $2,000. Cost of goods sold is going to increase by $600. And what I suggest you do, after today is, review the recording. Once I'll have it posted up on the website, usually by Saturday, I get these posted up, and review this. See if you can replicate all this on your own. Change the numbers around just to make it a little different, make it challenging, and see if you can predict the results. See if, and I'm going to show you this in a minute in QBO. You're going to see how I'm going to run the reports in QBO that confirm the cost of goods sold numbers that I calculated. And we're going to look at the journal entry side of everything so we can see how that lines up with, what I've laid out here for each of the transactions. So we're going to put this right into the bank account instead of undeposited funds, and save and close. Okay, so 61,299, click run. Sure enough, that's 59,299. Inventory asset is 600 less, exactly as predicted. Run this. There's my cell phone sales coming in at 2,000, right? And my cost of goods sold. And I created a separate COGS account so that you could see it very clearly. I should have done the same thing with inventory. But anyway, you can see the 600 coming in, right? So that's all perfect. Another thing I love to do, especially when I'm just trying to troubleshoot and make sure I understand correctly how things are being calculated, is back in the original entry, we're going to go to more, and we're going to look at the transaction journal. And that's going to create a report version of the debits and credits behind the scenes of that transaction, so to speak, right? So here it is. We debit checking, we credit sales, we debit cost of goods sold, we credit inventory, right? Exactly like I laid it out here. And notice it's doing it on the basis of $600, which means even though we've got both of these purchases recorded, it's clearly just using this cost because, again, it's first in, first out, right? So at this point, we should have 98 units of this at 300. Let's confirm that. Let's go to reports. And if I start typing inventory, you'll get the different inventory reports right up here. Let's look at the valuation summary, right? And sure enough, here's Greg Samsung cell phones. That's weird. It looks like sprinkler heads are like a sub of that somehow. That's very funny. All right, but we have 198 units total for a total asset value of 61.9. And it does, like I said earlier, it gives you a calculated average, but that is not what gets used in calculating cost of goods sold, as we've just seen, because we just clearly confirmed when we looked at that journal entry that it's using $300 a piece, right? Now, if I click on this quantity, of course, I can see the details. Let's do all dates. And now I can see everything. So we started out at 0, right? We purchased 100 at 300 for 30. We purchased another 100 at 325 for 32.5, right? And now we can see our sales of 200. This is the cost rate, right? That it's showing me that it calculated 300, right? FIFO cost 300. Quantity on hand, 198. So this is a really good report to sort of audit this stuff and make sure you understand exactly how things have flowed to confirm. Robin's asking, do I leave off the rate in inventory setup? It depends. If I know the rate's going to be pretty reliable, then I'll put it in. If I think the rate's going to change a lot, especially if there's different rates I charge for different customers, then I leave it out. So that's more of a practical question than any hard and fast rule on that. So we're talking about the rate that I put in that, based on what I sell it for, right? And so if anybody's not crystal clear on what she's referring to, it's because when I set this up, I did not put any rates in as associated with this. And I often don't. I sort of usually err on the side of not including it because my concern in putting it in is that then it's going to auto-populate an invoice here or a bill over here with the amount. And if I'm not paying attention, it's going to be wrong. By leaving it at 0, it forces me to look at that and determine. And usually if I'm entering a bill, I've got the bill right there that's telling me the exact rate I'm paying for it. And so I do err on the side of not putting the rates in for that reason. It's a way of sort of stopping me in my tracks when I'm entering the transactions later on and making sure that I have the correct rate, right? Because if I had put this in at 300 and then I bought the next lot and I'm really paying 325, but 300 came up and I wasn't paying attention, now I've got a bill in for the wrong amount. I'm going to send the supplier a check and they're going to say, hey, this is wrong. You screwed up. You need to send us more money. And especially with inventory, a lot of times, especially if you're buying stuff overseas, they're not going to ship anything to you until you've paid in full. So an error like that can cost you a lot in terms of time. right? And you could lose sales because you end up having to back order things and people are going to go somewhere else. Now, let's record the second sale, right? So sale number 2, we're selling 110 of them. All right, so we have some customer comes back. He says, I love these phones so much, I need 110 more of them on May 13th. He's got a lot of kids. All right, and this time, and this is my point, so by having the 0 there, it forces me to stop and put something in, right? So we're selling these still at $1,000 a piece for 110,000, right? 110,000. This time our calculated cost of goods sold is going to be the blending of the first 98 are going out at 300, and then the next 12 are going out at 325, right? That's our cost of goods sold calculation. This goes into the checking, right? So when I save this, what's going to happen, right? I'm going to see a whole bunch of money come into the checking, right? 110,000. That's going to put us back in the black, so to speak. I'm going to see 33,000 in inventory come out, so we're going to have about half of this left. And on the P&L, I'm going to see cell phone sales will come up to 100. It'll be 112,000. And of course, my cost of goods sold for cell phones is going to increase also by the 33,000 and change. Let's save it. This time I'm just going to hit save so I can run that journal report. Run it. Sure enough, now I'm back on the black with the checking account, right? Inventory asset, like I said, was going to be about half of the 60 some odd thousand that was there. Back up on this, refresh, there's my 112. And there's my cost of goods sold for cell phones, 33.9. Back over here, transaction journal. Okay, so and look what it does. It breaks up the cost of goods sold charges into the 2 pieces. So you can kind of see exactly how it followed suit with what I did. It had it in the other order, but we have 3,900 for one lot and 29.4 for the other. And sure enough, that's how they show it. So they actually split out the cost of goods sold based on the different rates because we crossed over that threshold of inventory that we were carrying at a cost of 300 into inventory that we were carrying at the 325. So on a FIFO basis, this is how you get the right cost of goods sold number, right? And notice, of course, on the inventory asset side, it's the same exact thing happening. Okay, and then cell phone sales going into the checking, that all, of course, balances perfectly and beautifully. So now you've confirmed that exactly what we kind of predicted down here and over here in our trial balance. I didn't do all of it here. I wanted you to see, at least for one of them, how it looks sort of succinctly in a trial balance kind of layout. But this all confirms everything that we predicted in terms of what this is going to look like and how this is going to impact the P&L. Now, if you can take the time, right, and study this and recreate what I've done here so that you truly understand this at the deepest possible level, you will be so well equipped and so far ahead of most other accountants and bookkeepers out there in terms of your understanding of inventory that A, again, you can charge a lot more because of that expertise and knowledge, but B, when somebody does come to you with a trickier situation, if you walk through an exercise like I just did, you can figure it out. And based on that, you can, as you're going through it, you'll start seeing where's the missing debit or where's the missing credit. And so understanding it at this kind of foundational level will help you get much better at how to record the stuff in QuickBooks Online. So when you get into a trickier situation, you can think it through in terms of the debits and credits. And once you have it down in that form, then it's easy to just go in. Then all QuickBooks Online is it's just forms that you're filling out to create what you now know has to get created in terms of the debits and credits. That's how I've started to look at QuickBooks Online. And years ago, before that, it's how I learned to look at the desktop, the forms in QuickBooks Desktop is I don't see them as forms. I see them in my mind's eye as debits and credits. And how do I need this to impact the balance sheet? And how do I need this to impact the P&L? And by learning to think about this stuff that way, it has made it easy for me. And at this point, I can honestly say you can have almost any client from any industry walk in my door, and I may have no experience with that industry, but because I know how to think through the transactions at this level, I can take on any client and I can figure out how to do the accounting for that industry. Almost guaranteed I'd be willing to bet money that I can't be stumped, only because I've taken the time and spent a lot of years learning to understand this stuff at the level that I just showed you, where I can really predict exactly what's going where and how it's going to impact what and in what amount specifically. Any questions? Good stuff? Just review or?
Just good stuff.
All right then. Well, then we are finished early, which is perfect because now I have a recording that's less than an hour, which will be easy to get up on Instagram. Even Robin said great stuff. Thank goodness. Cool. Well, you know where to find me if you need me. Friday.
Robin did have the question about, do you leave the rate off in inventory setup? And
I answered that. Where were you?
Okay. I'm not paying attention.
Perfect. Excellent. Yeah, so my quick answer on that, and I'm always curious, to get your take on these things, Greg, is I often leave the rate out on purpose so that when I'm filling out the invoice or the bill, it forces me to stop and look at the rate and make sure I'm entering the right rate.
That's the way that I would prefer to set it up as well, but oftentimes, and this is the function that you do kind of have to get a stranglehold on right away, is that you often have other folks getting their nose involved in the inventory, and and they'll often set up and say, oh, look, we all of a sudden have 20 of these items here, and they'll go in, set it up as an inventory item, load in the cost that it costs them without any consideration for the actual purchasing of it. They'll also, probably put the rate in there. They'll invariably put it to the wrong income and cost of goods sold account. So
yeah,
you got to try to stave that off.
Yep. Which is, by the way, why I love that transaction journal feature that I can grab behind any transaction, because it helps me understand. Because a lot of times where that really comes up is I'll be looking at the balance sheet with a client and he'll tell me, or actually rather, usually this comes up from the P&L where the client says, I don't think my cost of goods sold number's right. And so I can literally audit the numbers that way, right? Make sure it's bulletproof by going into the transaction in each transaction journal. And I've done this with clients where I'm in Zoom with them. I share my screen. I'm in their books. I drill into the cost of goods sold account off the P&L. I pick an invoice and I run that transaction journal and I show it to the client, and they don't need to understand debits and credits. It's very clear to them when they look at that report, which lines are the cost of goods sold, because it says cost of goods sold. And so I can say, so looking at just this one sale, does this number look right to you now? And they say yes. And I say, okay, but still benefit of the doubt. And in my experience, if a business owner says something doesn't look right, it's usually because something isn't right. So I'll do some more spot checks. It's exactly what we do when we audit books is we pick a sampling of transactions to test. And at a certain point when we test so many transactions and we confirm that it looks like this sample of transactions is getting the right cost of goods sold number, then we start to increase our level of satisfaction that the numbers in the bigger picture are accurate, right? The more transactions you have, the larger the dollar amount, the bigger the sample should be that we would use to test things and satisfy ourselves that it is in fact being calculated correctly. But what often happens is we can look into something, and here's 9 times out of 10 where I do uncover a problem. Like I said, I've learned I can usually rely on the business owner's spidey senses, when things don't look right. And what I'll find is that they're not caught up on entering the purchases of the inventory. And so the cost of goods sold number is not getting calculated correctly, in fact, and then once we uncover that, I say to them, okay, who at your company is responsible for entering these bills? A lot of times they say me. I say, great, go enter the bills. Call me next week. We'll do another Zoom and we'll confirm, because one thing I have tested and figured out, which is great, is that QuickBooks, when you go back and enter those bills, it will recalculate the cost of goods sold numbers based on that new information that's going in there. That's why those dates are so critically important, because no matter when the stuff got entered, that date is going to drive exactly how things are being calculated, especially in a model like this when it's not average costed, but it's FIFO, right? So that's that's a little bit more on kind of how this plays into the auditing side of things, when it comes to really testing and verifying that the numbers are in fact bulletproof.
Do you have a way that you would recommend we get people to stay out of the inventory so that they don't set things up?
Shoot them in the head. So
A legal way, I mean.
I mean, sometimes it's a question of just reasoning with them about it, right? And saying, look, until we're both comfortable that you really know what you're doing, stay out of it. You have to kind of find a polite way to say that sometimes to a client. Excuse me. The other ways you can lock them out. Some of my clients don't really even access QuickBooks. We do it, and then I just send them reports and review the reports with them. I have a lot of clients like that, where then they're kind of happier not to have to deal with the QuickBooks part, right? Sometimes the only way you can really nail a client down on like not touching something like that is and sometimes you just have to wait for it, but to show them a problem that they've created with their lack of experience at it. Obviously, we never want to insult our own clients, but we want to be able to show them respectfully, hey, here's what happened. This is what you did. And of course, QuickBooks Online has that gorgeous audit trail, so I can clearly prove who entered what and when, right? And that way I can, so that's often the best way to nail a client down on something like that, is to show them when they've made a mistake. And then that becomes your sort of leverage to say, so do me a favor, let me handle this for you. That's what you're paying me for. That's, by the way, another great way to motivate the client is remind them, this is what you're paying me for, so let me worry about it, right? And that way you're not insulting them and saying, I'm sorry, you're too much of an idiot to touch this. Instead, you're kind of putting it on yourself and saying, look, this is my responsibility. You're paying me good money. Let me handle it. That's often so. A lot of times, for better or worse, because we're dealing with personalities, the best way to motivate somebody to kind of comply with what your needs are is to appeal to their ego a little bit, sometimes more than a little, right? Just make nice with them. Nice. And it's usually not that hard, actually, after a while to get them to comply. But like I said, sometimes what it takes is to expose their own mistake to them, prove that they made it, and then use that as your leverage for why they should really let you handle it. Leave it to the professionals, right? And if you really have a good rapport with the client where you can kind of joke with them, then you can even use analogies like, hey, you wouldn't go and try and like change your own oil on your car, would you? Of course, some wise ass is going to be like, actually, I do change my own oil. Okay, so, but you get the point. All right, anyone else? All right, cool. That's a wrap. I'm going to go. I'll see you all on Slack. Ask your questions. I'm here 24/7, 365. I never sleep.
Yeah.